Hey everybody, it's Bo Beery. I'm a multifamily broker in the Florida region, and today we're going to be going over sell versus hold on a multifamily complex. Now, I know a lot of spreadsheets have been done on this and videos have been done on this. I promise you though, you want to stick around for this one because this one goes into quite depths on an Excel spreadsheet. It was developed by a CPA firm that I'm very close with. And the reason it goes a lot more beyond is because it includes debt information on your current property and on the next one you would buy. It takes into consideration the capital expenditures. It looks at a multi-year horizon. It's a far more holistic approach to looking at this question rather than the ones you've already seen, which just kind of have a very finite period of time and oftentimes comes up with the wrong answer, okay? And the reason I decided to do this video is because as a multifamily broker, I get told all the time, Bo, I'd sell, but where am I going to put my money? Or how the heck can I replace my cash flow? And that's a legitimate answer. I get it. But when I started using this spreadsheet over and over again, I found that there's a lot of cases in which someone said they want to hold it, but after they see what the actual hurdle rates are to get past there, they sell. And it particularly happens in up markets. Now, about the spreadsheet, it was developed by a company called James Moore and Company, and James Moore is an extremely reputable CPA firm. They have an office in Gainesville, Florida, but they're based in the Southeast. John Van Duzer is one of the principals and a good friend of mine. Very, very smart dude. I will put a link in the description to contact John or James Moore if you have any other questions on it. Also, as a disclaimer, I'm not a CPA, so if you are going to be making decisions from this video spreadsheet, I do encourage you to talk to your own CPA or your attorney or what it may be. All right, so we're going to now jump into this bad boy, all right? So on the Excel spreadsheet, I am going to, if you will just follow my cursor will be the best thing to do. So don't look at any of this over here right now or it'll confuse you. Stick with me on this side of the ledger. Everything in blue is a hard input, and then it spits out all the answers in the white, okay? So let me set the scene on the existing investment first. On the existing investment, you have a $5 million basis. Now, this is a number that you're actually going to have to get from your CPA. It's not necessarily what you bought the property for or what kind of money you have into it. This is a number your CPA has been tracking for the number of years that you've had the property. It's a number he can just quickly email to you, okay? I'm assuming that the land is 25% of the value, and this is more for depreciation purposes later on in the spreadsheet. I'm assuming the personal property is about 0.5%. That's furnitures and you know, office furniture, supplies, things like that. You require the deal, let's call it 6 years from the date of this video in 2014. It's now 2020. NOI is $550,000. You can sell today for a 5.5 cap. The closing costs and commissions are 4% combined. Your current debt balance is $3.3 million. There's your principal and interest payments of $241,000 on a 5% interest rate. And we're going to sell a few months from now. Now, if you'll see here, this is a drop-down menu for like-kind exchange. And I have no in there because, you know, I want to analyze the worst-case scenario. The worst-case scenario is you sell this property, you pay taxes on it, and then you go buy something else. And how did that buy compare to whether you would have held the property? And so, obviously, most cases, if you sell a property and you can 1031 into one that makes sense, you'd probably do that. This way, I'm looking at no 1031 exchange. I'm assuming you will be subject to the NIIT taxes. If you don't know what that is, Google it, you'll find out. I'm also assuming that most of you are in the 37% tax bracket, which is the highest ordinary income tax bracket. And this is used to calculate basically the taxes on the personal property. All right, so that's the existing conditions on your current property that you own. Now let's look at if you sell, pay taxes, and buy a new one, what's the new property metrics? So I assume that we're going to buy the next property at 70% loan to value, which is mostly what happens, anywhere between 65 and 70. 5.5 cap. So you're going to sell for a 5.5 cap. I'm just going to assume that you're going to, worst case, buy at a 5.5 cap. 3.25% interest rate, 30-year amortization. let's look at a 7-year hold. You can put in whatever number here you want. Your net income, not your potential gross income, but your net income is going to increase at 3% per year. And we're going to sell 7 years from now at a 6% cap rate. By the way, this spreadsheet I'm happy to give to you. Just email me. I'll have my contact information in the comments, or you can go to boberry.com. And when you go to these cells, you'll be able to look at what's input in the cell or what the equations are. Okay? So now, let's look at what happens when we sell the property. Okay? So if we sell the property, as we said before, we have $550,000 in NOI. That's our debt service. So the most important number in this whole spreadsheet is the before tax cash flow, which is $308,000. That's the number that's after all your expenses and after your debt payments. You're putting 308 in your pocket, burning a hole, right? So that's our basis. That's what we're going to try to beat by buying something else or deciding to buy something else. So you sell this property for you sell your property for $10 million, which is $550,000 NOI divided by the 5.5 cap. You do the math, it's $10 million. You pay off your debt, you pay off your commissions, or you pay off your closing costs, excuse me. You have $1.3 million in taxes, and you're going to walk away at closing and after taxes with $4.9 million. Now, where do I get the taxes from? Here's where this spreadsheet becomes, a lot more, advantageous or a lot better than some of the other spreadsheets you've seen in the past. It calculates the taxes, and this is where a CPA comes in. So let me show you how we get to the 1.3 million. You've had this property for 6.67 years, right? Because you bought it in 2014, you're selling in 2020. Your land portion is $1,250,000. Your personal property, which we talked about was 1/2 of 1% here, comes out to about $25,000. So your total cost basis in the property is $4 million. Now, as we said, we're going to sell for $10 million. We have a cost basis of $4 million. You get to write off the closing cost. So you have a total gain for tax purposes of $5.5 million. You're going to pay $9,250 on that personal property. You have depreciation taxes of 25%, which is $225,000. You're going to pay long-term capital gains tax of 20% currently in 2020. That comes out to $920,000. And then, of course, you have the NIIT tax, so that comes up to $1,365,000. As I said, I'm happy to share the spreadsheet with you. You click on any of these numbers, it tells you where this equation is coming from right here at the top, so you'll be able to follow it. I'm not going to do that here on the video because it's already going to be several minutes long. All right, so that gets us to the 4.9 million over here. Now, as I said, we're going to be comparing holding the property to buying a new one. So let's buy the new one. Since we said we're going to buy with a 70% loan to value, when you do the math, that gets us to be able to purchase a $16.3 million property. And 70% loan to value is an $11.4 million mortgage. Okay? So, I want you to follow me. As we said before, our before tax cash flow on our existing property is $308,000. But if you go and buy another property at $16.3 million, it's going to have debt payments of $600,000. So we have to find a property that is bringing in enough NOI so that when it pays off its debt, we will end up at least the same cash flow as we currently have on our existing property. So if you do the math, if $600,000 is the debt on the new purchase, which is calculated by this information right here, then we need $904,000 in net income on the new property in order to get to that 308, which comes out to a 5.55% cap rate, which is damn close to what we're selling our property for. So you may say to yourself, Bo, well, shoot, maybe I should sell because I can probably go buy a triple net asset somewhere else, not even have all of the labor of running a 200-unit complex. I can just go buy a triple net asset at 6% cap rate and beat this. And if you stop here at this analysis, you're probably right. But the beauty of this spreadsheet is now we're going to look at holding our current property for 7 years and all of the benefits of that, compared to if we sold that property, paid taxes, bought a $16.3 million property, held that property for 7 years, and how do the two look side by side? So let's get into that. All right, so our existing property that we own right now, let's look at that. If we held it for 7 years, that $550,000 in net income is growing at 3% per year for 7 years. So in 7 years, when we go to sell it, we'll have NOI of $676,000. We said we're going to sell in 7 years at a 6% cap rate. So that's an $11.3 million sale instead of $10 million. We've got closing costs of $450,000. Our debt has been paid down much more now. So instead of it being $3.3 million, we paid it down to $2.7 million. So we're going to walk away with $8.1 million. But during that 7-year hold, we had cash flows we were putting in our pocket that cumulatively added up to $2.5 million. I assume during the 7-year period, you're going to put $300,000 towards CapEx, air conditioning units, you upgraded the clubhouse, you put down a blacktop on the parking lot, whatever it is. So your total cumulative value of holding for 7 years was $10.3 million. Now let's look at that compared to we bought this other $16 million property and held that one for 7 years and see if it was a wise decision or not, whether or not to sell. So on the new property, that new property now has in 7 years $1.1 million in NOI. We sell at a 6% cap rate. Now we're selling for $18.3 million. Remember, we bought it for $16.3 million. We're paying off our closing costs. We're paying off our debt. So we're walking away with about $8 million. We had $2.7 million in before-tax cash flows cumulative over that 7-year period. I assumed we put in $1.5 million. Sorry, my alarm's going off. I assumed we put in $1.5 million because I'm assuming you're buying a value-add property and you're going to want to upgrade the property a little bit to get higher rents. And so I assumed $1.5 million, and you do the math, you're only at $9.1 million over that 7-year period. And we were at 10.3 if you held it. So you're losing $1.1 million in this particular scenario by selling and buying another one, by selling, paying taxes, and buying another one. Now you may say, Bo, well, that's not fair. You're putting in $1.5 million. Even if I put in the same $300,000, we're barely positive. Now, would you go through all of that to just break even on your existing cash flows? You wouldn't. The beauty of this spreadsheet, though, is that you can change any of these numbers, and that could dramatically change the outcome here. So it's just plug and play. I did a scenario here where it makes sense to hold. I've done a bunch of them where the seller was adamant that he can't replace his cash flow, and I plug him in here, and darn sure enough, he should sell right now. So anyway, I also just want to point out, if you have any other calculations you want me to do, have any other scenarios, things you'd like me to post videos on, I love doing spreadsheets. I love talking about how to buy multifamily, how to sell it, how to find it. I've been doing this business for over 20 years. So please reach out to me. Comment in the comment sections what you'd like to see me do next. Comment maybe how you evaluate whether you should sell or hold. And that's it. Please like. Please comment, please subscribe. That really helps out my channel a lot, helps with all the algorithms with YouTube. Hope to see you on the next one, guys. Talk to you later.